It's been a week since SoFi reported their latest quarterly figures, and while the stock is still down around 11%, maybe at the time of making this video, futures pre-market might be extremely red because of all the panic around the tariff saga. Now, let me remind you, if you missed yesterday's videos on AMD or the tariff video, in 2018, at the end, there was also a trade war with China. Do you know what happened since the bottom of 2018, since that trade war? Well, the Nasdaq is up 260%. You also know what happened back in March 2020, pandemic, a much bigger deal than a stupid tariff war right now, right? The Nasdaq is up over 200% since then as well. So in the short run, there might be a lot of volatility. Things can go up, things can go down. But let's still focus here on the long game. Let's just focus on the long-term success of our companies in our portfolio. Because who knows, maybe in a week from now, the tariff thing is gone and we move on. Could very well be, because I still believe this is just a way of getting the players to the table and discussing some new deal. That's just my opinion, of course. Anyways, let's talk about a couple of things that I wanted to cover again with regards to SoFi that I might have missed in the previous video. So if you're new here, hit that subscribe button. We really appreciate that. We're trying to reach 100,000 subscribers this year, so I would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So SoFi, at the time of making this video, still around $15.60 or so, has a market cap of $17.28 billion. And in the last couple of days, basically last week, the stock is down, let's call it 12%. But as you can see, year-on-year performance, stock is up 87.86%. And in the last 6 months alone, the stock is up over triple digits. So let's not complain about these last couple of days, shall we? Now, if we look at some pricing metrics here with SoFi, we can see that forward PE is now at 63.5 times, because as you can see, we now have fiscal year 25 EPS here at 25 cents. Fiscal year 26 still only here at 46 cents, even though management told us that they are still expecting that midpoint 67-68 cents. So do with those estimates what you want, but don't make decisions just based on pricing metrics, because those pricing metrics are based on analyst expectations. At the time of making this video, the average analyst price target sits 15% lower than the price we're at today. And while last quarter might not have been the best quarter out there, especially not because of that guidance, let's just look beyond 2025 and what management told us. They now expect to exceed their medium-term guidance of delivering 20 to 25% compounded annual revenue growth through 2026, and they remain confident in delivering 2026 EPS in the range of 55 to 80 cents per share. Moreover, we are well positioned to deliver 20 to 25% annual EPS growth beyond 2026. So, let's focus on the big picture here, because this is exactly what we wanted to hear. As long as this does not change, or at least not on the downside, I don't think there is any reason to panic. And remember, SoFi's own outlook is always more bearish than reality. We've seen that in 2024, and we're seeing that again in 2025. Even though in 2025, there's also a reason why earnings expectations are coming down, or earnings guidance is lower than expected. It's because the company does want to invest more in the business. That's also why you're seeing higher revenue, but a hit on profitability. But what's even more impressive is that they can control their profitability of the business, right? This year, they say, okay, you know what? We're going to be a little bit less profitable, generate still more revenue, we want to invest more for the business for the future. But then they also still know right now, because that 2026 guidance and beyond that is still reaffirmed. So they have extreme control on the profitability profile of the company, and that's very, very impressive. Zooming out, we can see that this business, despite all the challenges, has been growing extremely well, especially lending revenue and, well, of course, financial services one. As you know, it's still very disappointing to see the technology platform grow, well, barely grow, let's say. Then again, we had 3 announcements that we will only see the main impact of that in 2026 and onwards, so I guess we'll have to wait another 12 months. Okay, as long as these 2 segments here continue to grow quite quickly, especially financial services, I think we'll be fine. Another comment I wanted to touch on from the earnings report. Anthony Noto said in 2023 we had set guidance with a 30% incremental EBITDA margin. We wanted to show evidence of that. In 2024, we took a very conservative stance at the same point last year relative to others based on interest rates, the economy, inflation, geopolitical, etc. And because we took that very conservative stance, we drove margin expansion at the expense of revenue growth. And we delivered well more than 30% incremental EBITDA margins, which is evidence that we can do that and maintain growth having just grown 25%. And in 2025, we're just tilting the balance back. I want to make sure we're taking a long-term view to drive revenue growth for as long as we can. And when it slows, then we'll drive the margin growth. So yes, we've seen revenue growth, right? The growth rate decelerate, but I expect that to reaccelerate this year. Then with regards to what's going to be a very, very important and lucrative aspect of this whole business, and that's the LPB, the loan platform business. The CFO during the call announced a $5 billion loan platform business contract. And as you can see, all in all, this is still fresh, but growing quickly and helping the profitability profile of SoFi's business. Loan platform business posted record results, generating $63.2 million in loan platform fees, driven by $1.1 billion of personal loan volume generated on behalf of third parties in the quarter. In the full year, their loan platform business originated and transferred a record $2.1 billion of personal loan volume. For the full year, fee-based revenue generated $969.9 million, and that has increased 74% year over year. Now, why am I repeating this? Well, because as I said in the past video, I think I did miss something during the earnings call, so I went back and that's exactly what I wanted to find. So one analyst asked here the following: it's great to see the mix shift in revenue and the rise in fees as percent of the total. Can you, sort of looking long term, talk about perhaps where you'd like to see fees as a percent of the total given your long-term ROE aspiration, and what that composition of that fee-based business might look like, say either in an intermediate time frame or even a little longer time frame? So Anthony Noto said here, it's really hard to give you a specific number given it's being driven by 5 different sources of revenue. We would want it to be very significant. We recognize that it's capital light, it's less credit risk obviously, and it's cash upfront. So it's high, it's also high ROE. We want to grow it as large as we can, and here it comes. One of the things that we contemplate is, could we push all of our lending into the loan platform business over time? And I'm not opposed to that at all. The economics are very attractive, the velocity is much higher, the capital is lower, you have a lighter balance sheet, it would really support high ROE. And I think him saying that already in this earnings call gives us a hint where the company is definitely going to go. And it's true. You can have a lighter balance sheet, basically minimizing your risk, but still increasing that origination growth, which again, fee-based revenue businesses, like, many of the Emir calls them mafia type of stocks, are extremely highly valued. Switching to 2 other things here, he was asked about crypto, and he said the following: as the regulation changes, we will be incredibly aggressive tied to crypto and be in as many businesses that we can be across the entire platform. Talking about crypto, it does not want to offer just crypto trading, so maybe that could be going into, crypto custody, things that Coinbase is doing. Now, with regards to the financial services platform, Now, with regards to the tech platform, they expect to grow 2025 low double digits to teens, and given that lead times and implementation cycles have been longer than expected, we now expect to grow revenue at mid-teens CAGR from 2023 to 2026, which is a bit lower than previously expected. In terms of the margin profile, you can expect financial services were about at 45% margin and $81 of annualized revenue per product. And here it comes. We're still under monetized in Invest, So there's opportunity, and we're starting to scale our loan platform business. Loan platform business, by the way, does not go into the lending business, but comes into the financial services one, just so you know. So they're starting to scale their loan platform business, which is generating margins at around 50%, slightly north of that. So you can expect to see continued margin expansion in that business. With regards to contribution profit for the quarter, we've seen some continued progress here with lending, with financial services as well. As you can see, financial services year on year is almost up 5x, which is crazy. Tech platform is a bit flat-ish. You can see the big picture right here, right? Lending contribution continues to go up. We've seen this nice reacceleration in growth, of course, in the last 2 quarters. And then, well, financial services is starting to show its strength. And while I know that some investors might only be looking at, oh, look at Q1 guidance or look at fiscal year 2025 guidance, it's lower than expected, blah, 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 stock is down 12%, it's the end of the world. Well, no, not really. I think with SoFi, we're far from the end of the world. Like I showed you, in the last 6 months alone, this stock is up over 100%. In 2024, they focused on profitability. In 2025, they are very, very comfortable with where they're at with their profitability, and so they're focusing more on revenue growth. And then in 2026, they still expect to reach their own targets, even after all of these headwinds, all of these changes in strategy and all of that, which again is amazing. And if the stock does come down more, because we are under the 20-day moving average, maybe because of the whole tariff drama, we might even go under the 50-day moving average, which we've been under 2 weeks ago. We've been at around, well, actually under $14 2 weeks ago. So it's not that horrible. Now, again, if we can go even lower around the 200-day moving average at around $11, could be a possibility. And I'd be definitely buying more shares if we are closer to $11. If we are, that means that there is a broader, let's say, market correction. But then again, we are fully in earnings season. So some stocks can go up and down based on results, based on, well, leaders in their industry that can impact other stocks. We've seen that play out before. Plenty of companies will report earnings in the next couple of days. PayPal, Uber, Alphabet, Amazon, etc., etc. We're of course going to cover all of them on the channel. So if you're new here, again, hit that subscribe button. We really appreciate it. Like, comment, and I see you all in the next one. Bye-bye.